Hey everybody. Hopefully you're having a good day. My name's Andy. My channel's Finding Value. If you like making money, this is the channel for you. Subscribe to the channel. We look at the most undervalued assets in the world. Give me a thumbs up for this content. By overwhelming vast majority, 70 something percent, wanted to see and learn about call options. Now, I am only doing call options because that's the only thing that I do. I am not an options specialist. I only use this stuff. I am an investor, a regular guy, just like you. All right. So I'm not an options specialist. I only throw call options on. I don't do straddles. I don't do anything funky. It's like I can read the charts pretty well, and I'm sure a lot of you guys know that by being on the channel for a little while. I put them on just to make a little bit more money. Also, it keeps me occupied, so I'm not fidgeting around with the portfolio because it focuses and fine tunes my chart reading skills. So that's why I do this every once in a while. I don't do it all the time. This is extreme risk. So I am not by any means telling you guys to get into this. You guys wanted to learn about it. This is what it's about. So call options. I'm only doing call options. There's more than just this. This is the basic stuff. So call options. Again, I'm not an expert in options trading. I'm never claimed to be. I use options when I see opportunities that are large. That's when I use them. I only go into them if I have full alignment with market conditions, valuations, and technical analysis. That's the only time. They can provide a lot of leverage to a move, and I have a strategy of investing in these things. I do not put all my money in one of them because they can go in the opposite direction very quickly if you don't know what you're doing. They can really they can expire worthless very quick if you're just lollygagging around not knowing what you're doing. So what is a call option? It's the ability to have the option to buy the stock at a certain price. Each option contract has the option to buy 100 shares. Now, these aren't free. So options they basically are priced on a per each basis. So that's each share, and each contract is worth 100 shares. So if it's 45 cents each, the contract costs $45 in total. So you have to multiply it by 100 for the contract cost, but it's priced in each. Options have an expiration date, and the premiums will adjust based off of those expiration dates. So the value of options, value is derived in three ways. It's the price moving in the direction you want it to, because if it goes in the opposite direction, it goes in the opposite direction very quickly. It's not a few percentage move. The strength of that move in that direction, volatility. So if you want it to go up, you can get the price to move up, and depending on the price move, the power of that move, we'll call it the volatility, also gets priced into the option. And it's also the time left on the option. So when we place an option, when you see an opportunity that could be outsized, a large asymmetric bet that could be huge, large chart break patterns, an environment where things go vertical very quickly, which we're in today, and you see an alignment with valuations and market conditions. So I have to see an alignment on all of this. Otherwise, I won't do it. Now, options, and I call it stress. So options are not for a lot of people. A lot of people worry about options because they have time decay. If the price moves against you, it really moves against you. So you got to be knowing what you're doing, and you got to be very good at technical analysis and looking at all of these things. A lot of people lose a lot of money doing options. In a call option, you can only lose what you put down as a premium. I would say you need to be living and breathing the market to win at options consistently with an investment strategy. You have to have all of it. Now, an investment strategy, what I do, and this is just me, I put a small percentage bets placed in high reward companies during dead periods of the stock being traded. Dead periods is low volatility. So the dead periods before a stock moves is lower volatility. So the premiums are lower because it has lower volatility. It doesn't have a lot of interest by many. And typically the options are priced better, very cheap. And I'm going to go into what it looks like. So this is kind of what it looks like to win and lose in an option. This is First Majestic Silver, or no, I should say Fortuna Silver Mines. It's at 765 the price. And let's say you were to do a $9 call option for March 19. This is what you're at, roughly 765 right here. This is what the line is going across. Now, if the stock goes nowhere and you hold an option, you are losing money. This is what the negative amounts are in terms of percents. You have to have the stock really move up, move up for you to make a profit. Now, if this thing were to go up to $12, that's a big move, but let's just say it goes up to $12 and it does it in a little over a month. So it really rocketed higher. You can have a return of 580% on a call option, $9 out of the money call option. So out of the money means that this would expire worthless if the stock doesn't move into or above $9. Now you can still make money because you have time left on the contract if this thing moves to the upside very quickly. So if it moves to $9, you can double your money, 133%, 127, 118, 109. You could double your money with a pretty good bet here if it moves from $7.80 to $9, which I think is a pretty high likelihood if you can read charts. So you can really double your money. You can get up in the 200% range, 300%. And sometimes you hit one out of the park and it goes up 500-600% in almost a double very quick. Because some of these they go vertical pretty quick. Now, if it doesn't go anywhere and it goes down, you can lose money and it expires worthless pretty dang quick. So it's an all or nothing bet is the way that you want to view this almost. And I don't do straddles. I don't do any of that other stuff. Covered calls. It's that is a whole different topic, and that's not the purpose of this. So another one, if you were to look at a $15 call option January 2022 on the same stock. This is what this kind of reward, and notice there's a lot more red over here. So you got to really be on it. You got to have the stock move pretty quick. And you want to get it where a $9, if you go to $10 here, it's not 100% gain anymore. So notice that on a longer duration contract, the gains are not as much as a shorter duration contract. So a short one, if you nail the timing, you can get, and it goes to $10, you can get a twofold, threefold, fourfold increase depending on where it goes. Here, you'd only get an 80, 70, 60% increase. So if you think of something's going to move very quickly, what I typically do is I go after the shorter duration contracts. I would go after a March or April contract versus a year-long contract. The year-long contracts are very good if you think you're going to get a massive move. And it's going to go up substantially over the next 4, 5, 6 months, which is sometimes you might want to take those bets. So what options to choose? If you've got first Fortuna Silver Mines at 765, at 850, $10, and $12, this is what the stock would move to. It's an 11% increase, 31% increase, and a 57% increase. What option would you choose? Would you choose a March 7, which is in the money, January 7 in the money, and then we have all the other out of money call options? What I see just by looking at this, I like the March $9 out of the money call option if you can read charts pretty well, because you can get a little bit of a return if it doesn't do much, but you get very large returns at a 30% and 57%. I mean, those are big returns. And I'm doing this based off of my chart reading skills. I can usually predict about a 30, 40, 50% move on some of these small cap companies. And if you can get a really good price on the premium, I might take that bet. So I would gladly receive a return somewhere in between here if I can. 224% and 593%. I'll take a 3 or 4 bagger, easy. Now, you can also choose a June contract, which is a little bit further out in the future. It does reduce the returns, but what if you get caught in the stock and it goes sideways for a little bit before it moves up? So this is another way that you can kind of hedge your bet, and you still get really good returns on. It's about a tripling of this return, and then I would say almost 4 times the return of this. So that's pretty good. That's pretty good to do a June 11 call on it and get these returns. Even June 9, if you notice, the further you go into the future, the returns start to equal each other. So you can kind of choose any of these, but I would choose the June 11 because the premium is typically a lot less. And if you have a move that's very quick, that happens very quickly, I would choose a June 11 because the returns are pretty close and you'd still have a lot of time on the contract to sell it. So if you think a move is going to happen pretty quick and you want to hedge yourself, you can get like a June, but I would go out of the money a little bit further with cheaper premiums because the returns are pretty close to being the same. Now, if you're going to go and do a year-long 2022 in January, these are the returns if the stock moves in February, like in a month move, and it goes to one of these prices in 1 month. And these are the returns. I would do a Jan 15 because the returns are basically the same and you can pay a lot less in the premiums. If I were to do a lot of these, I typically do like a month or two out, and that's about it because I'm pretty good at reading charts. The move typically happens within a month, and that's when you get the most returns, and that's kind of how I do it. But if I think a very large move is coming, that's when I go out maybe 3, 4, 5, 6 months to hedge myself. And if it's a very big move, if I think this thing could go 3, 4, 500%, then I go out and try to do like a 6-month one. So what I typically choose an out-of-the-money call option is what I typically do, with the option being a good striking distance from the current price, given the current chart pattern. So I think it could potentially go in the money. Sometimes I put on 2 options on the same stock, but at different time intervals. I might do a March option of $9 and a June option of $11 in the example that we gave, and that's actually what I did on Fortuna Silver Mines. Options are good if they work for you. They're absolutely horrible if they don't. It's like a very asymmetric bet. They transfer all your money to others if you don't know what you are doing. You just literally give them all your money. So there's different strategies. Some go after smaller gains and take in the money options to go after higher probability bets. Sometimes that's I think that's a good strategy to buy an in-the-money call with a very short duration. And if you think it can go up 10, 20, 30%, you can do that and just get those small hits, so to speak. You go after the small little hits. And I think that's a very good way of making money. Some do out-of-the-money options and go after larger returns. That's what I do. I don't use them as much. So if I'm going to use them and I see a very good setup, I swing for the fences. That's just kind of who I am with the money that I have in this account, which isn't very much. Some people do both strategies. I think that works. And since these are asymmetric bets, developing a strategy for betting works very well. And you've got $2,000 allocated to this, let's say. Perhaps you take $200 betting sizes or even $100 betting sizes. Take more bets and reduce the risk if you lose. Don't take bets just to take bets either. You got to have good probabilities of it going up. You don't want to just be throwing money all around. You have to be very disciplined. You have to see a good entry point, take the entry point, and then you have to sell it when I sell it when the thing is still moving moving quite substantially and the volatility is still high. I try to get out. So this isn't necessarily about maximizing your returns. It's more about getting a very large return quickly and getting the hell out. That's the way that I kind of see it. And more information here. I rely very heavily on technical analysis when you're doing this. I look for confluence, which is the merging of information, off of value, market conditions. I look at the entire sector. So I'm looking out the side windows at what all the other companies are doing the same time I'm putting this on. I'm looking at the commodity itself. I'm looking at yields and which direction the yields are going. I'm looking at the value of the dollar. I need all this to align for me to take these bets. You need to be on point with everything because you can lose very quickly. Emotions get in the way if you have not mastered your emotions. We need cold, calculated, statistical bets here. And what I mean is you can't be emotional. You just got to say, I lost, move on. Or you see the stock moving sideways, you're down 20, 30%. You just sit and wait because you know how to trade markets. You know how they move. You know how they position themselves and how buyers and sellers interact. You have to just let it go. You almost have to mute your emotions completely and not be a human being for a little while. And sometimes different brokerages only allow you to set the limit order in 5-cent increments. So you got to watch out because if a stock, you might have to move quite substantially to make a gain here. And if the premium is at 23 cents and you bought it at 20 cents and you can only sell it in 5-cent increments, you might have to put a limit order at 20 cents and it fills at 20 cents. You didn't make any money. So that's what I mean by the 5-cent increment. And the conclusion here is if you don't know much about the markets or technical analysis, I would definitely stay away from options. You're going to lose your butt. I would only put options on if everything is aligned. And betting strategies are needed when using this approach because you can really get messed up if you don't manage your risk. And I manage risk with the betting sizes that I take, and then I take more bets to win. Many walk away losing everything that they started with in this game. So this is not something that is for new investors. This isn't something that you just start throwing a bunch of money at. I would definitely say go and buy stocks, not options, if you don't know what you're doing. Stocks, there's no time frame. You just buy it, you own it. It's a piece of the company. Far less risk. This stuff here, this is only if you know what you're doing and you're wanting to put a little bit more on the bet. If you guys like this content, give me a thumbs up. Let me know how I describe using options. Hopefully you guys understand it. Leave it in the comment section what you guys think. If you want more options, if you want to learn more about options, I can do more. Again, I'm not an expert on this stuff. I try to take an approach that is very easily understandable. Hopefully you guys understand this stuff. And be very careful using it. I am not recommending anyone to do options unless you have been in the markets for at least 5 to 10 years. If you guys like this content, subscribe to the channel. Give me a thumbs up. And thank you for listening. This is Finding Value.